I think for the late starter, maxing out or coming as close to as we can those traditional deductible retirement accounts, right? I'm seeing this out there in the personal finance space. You got to do Roth, you got to do Roth, you got to do Roth. I disagree with that for many reasons, but particularly for the late starter. The late starter needs to build up the numbers on their balance sheet. And the easiest, quickest way to do that is through traditional deductible retirement account contributions, particularly at work. And you should feel good. If you're a late starter and you're like, look, I'm now going to commit to maxing out my traditional deductible 401k. If you don't do year-end planning, you can get in a situation, maybe you're early retired and you got a big standard deduction and you file a tax return with a negative number based on a relatively modest income and a large standard deduction. It's possible for some retirees out there to file a tax return with a negative number. I typically think that's a bad outcome, right? That's a missed opportunity.
Welcome to Catching Up to FI, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Becky, and I'm also a late starter, and we're your hosts. We're here to help you with your journey to financial independence, no matter where you're starting from.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
Hello, and welcome back to Catching Up to FI. I'm Bill Yount, back with Becky Heptig. She's been on the other side of the world for a while. We haven't recorded together in a good bit. Jackie stepped in admirably, but Becky's back, and we're here today with Sean Mullaney. We're very excited about this, but first, I want to hear a little bit about Bali, since that's been a big topic for Becky.
It has been, and I am happy to be back. Thanks, Bill. And I am so appreciative of Jackie for standing in for me while I was gone. I haven't been behind the microphone for 4 weeks, so this is going to be interesting, but we're going to move forward with this. Bali was great. It is literally on the opposite side of the world from the Eastern time zone. And it was a long flight to get there. But there were 46 of us at Amy's 5 Freedom Retreat. It was awesome. We had great speakers. It was a great location. And Amy added in a dimension to her retreat that you don't normally get at a campfire or economy. Because we were in another country, she built in opportunities for us to see the culture and real life in Bali. It's a place that she loves and has been immersed in that culture. And so she shared that with us. So we had, on one end of our spectrum, we were in a resort bubble at the beach. It was beautiful. And you didn't know the outside world was there. And the other end of the spectrum was we spent some time in some villages out in the countryside. We saw them planting their rice paddies. We saw how they lived, what they do for income. And it was just very different and very interesting. So it was a great trip.
From a money standpoint, the currency was interesting. Tell me
my gosh. It took a long time to wrap your head around it. The currency exchange rate is about 15,000 to 1. So $15,000 IDR is their currency, is $1. So you would go to a restaurant, and things are actually inexpensive there. Well, you would go to a restaurant and you see these huge prices on the menu, and your brain would go, wait, I need to pay attention to what I'm ordering here. But yet everything on the menu would be like $4, $5, $6. But the prices were in the hundreds of thousands, sometimes millions. We would go across the street and get a massage, an hour-long massage that cost $130,000 IDR. But that is what, I don't know, like $8. So
yeah, that's incredible.
It just blew your mind all the time. We would go to the ATM. A lot of places we went did not take credit cards. So we would go to the ATM to get cash, and the max amount you could get out was $3 million. So we just were laughing, saying there's just millions flying out the door.
Well, it sounds like it was awesome. And we have a episode coming from Bali in the next couple of weeks. I have to apologize for my voice today. I had lost it completely at the Bogleheads conference. It's coming back, but this has been a long recovery. It feels like a disability. And for a podcast, not to have a voice is a bit of a problem. Okay. Well, Let's jump into our episode today with Sean Mullaney. Becky, can you reintroduce him for our audience?
Absolutely. Today we're talking to Sean Mullaney. Bill and I talked to Sean back in episode 13, Life and Taxes. In that episode, Sean spoke about the basics of retirement accounts, and then we dove into the tax aspects of those retirement accounts in the accumulation years and the drawdown years. If you haven't listened to episode 13, give it a listen. Sean does a great job of speaking IRAs and 401ks. So just as a review, Sean is a financial planner who offers fee-only and advice-only financial planning at Mullaney Financial Tax Incorporated. Sean is most well known in the FI community, though, as the FITaxGuy. So today we're going to have a conversation about year-end tax planning. This is a very timely and important topic. Sean will give us a taste for what we should be thinking about for 2023 and 2024. Sean, it's always fun to talk taxes with you. Welcome back to Catching Up to FI.
Becky and Bill, it's great to be here. Just as a quick reminder for the audience, right? What we're going to talk about today is educational knowledge and information. It's not individualized tax or investment advice for any particular individual.
Awesome. So, Sean, my first question is, why do we need to think about taxes before the end of the year? I mean, we do our taxes for 2023 in April of 2024. So why do we need to think about it now?
I think the biggest thing is missed opportunities. So I've seen this, right? If you don't do year-end planning, you can get in a situation, maybe you're early retired and you got a big standard deduction and you file a tax return with a negative number based on a relatively modest income and a large standard deduction. It's possible for some retirees out there to file a tax return with a negative number. I typically think that's a bad outcome, right? That's a missed opportunity. But there's also opportunities for the accumulators in the audience, right? We'll talk about things like Backdoor, Roth. We'll talk about things like charitable contributions, which can apply in the accumulation phase and the drawdown phase. What happens is once the ball drops in Times Square, East Coast folks, that's it, right? So your opportunities for 2023 go out the window. Now, look, 2024 could itself present a lot of opportunities, but there are going to be some in the audience where, boy, doing things in 2023 are going to make a lot of sense. And you just want to be intentional around year-end tax planning, right? You're going to have opportunities in the future, sure, but 2023 is its own unique opportunity, and there might be some year-end planning that could be very effective.
Well, let's jump in. You have a blog post on this that we want to refer people to, and it'll be in the show notes. The first thing you wanted to talk about is charitable contributions and donor-advised funds. Can you describe for us what that is and then take us through what you recommend with regards to those?
Yeah, this is a great one. So I like to say there are many Americans out there, maybe some in the audience, who should never again give to charity out of the checkbook or in a credit card. These are folks who happen to have appreciated stock, and this exists out in the world, right? So maybe you worked for an employer for 20 years and you were in the employee stock program and you happen to buy low and the stock went through the roof. I've seen that, right? I've seen multiples where I had to research it to make sure that it was the correct multiple, and sure enough, it was. There are some people sitting on big capital gains in individual stocks. Maybe it's their employer. Maybe they took a gamble on a tech stock 20, 30, 40 years ago, and the returns are now 1,000x, right? So what happens is you get this big looming capital gain there. You don't want to pop that, right? That's a big taxable gain. But what you could do is for your charitable giving, you can just directly give the appreciated stock to charity. So folks like that idea, but it is a little weird from a charitable perspective. So think about going to church, right? You give every week or maybe every month. You don't want to go to your church and say, hey, here's $10,000 worth of Apple stock. I'll be back in touch in 3 years, right? That's not how folks like to give to charities. So what could you do instead? Well, there's this nice little mechanism, the donor advised fund. It's nice and low cost, and it does a lot of different things, right? So what you do is you say, oh, I've got $20,000 worth, say, of Apple stock, and it's got a big built-in gain. I don't want to pay the built-in gain, the capital gains tax on that. So I'm going to work with a financial institution to directly transfer, not sell, transfer in kind, right? $20,000 worth of that Apple stock, say, from my brokerage account to the donor advised fund, right? And what that does is it does two things. One, it eliminates that capital gain for all of human history. And two, it gets you a $20,000 tax deduction. So that's two great tax planning aspects. And we might want that $20,000 of tax deduction to be on this year's tax return. So from a year-end perspective, we're going to want to act sooner rather than later if that's what we're looking to do. What it also does is it normalizes the charity's experience, right? So we're not going to give 20,000 worth of Apple shares to our church and say, okay, yeah, don't call me for 3 years. I'll give again in 3 years. No, what you might want to be doing is giving $500 a month, $1,000 a month, and sort of what you do is you go into that donor advised fund and you recommend to the donor advised fund that they give to the church. The donor advised fund is going to accept that recommendation as long as your church is a 501c3 charity. And what you've done is you've accelerated, you've taken a nice big tax deduction in 2023. You've eliminated a long-term capital gain. We really like that outcome. And you're still giving to the church in a way that's more normalized for how we typically like to give to charities. When we talk about year-end and donor advised funds, here's the thing. Donor advised funds are becoming popular, right? The word's out, and so you're going to need to move sooner rather than later. Technically, the deadline is December 31st. But if you're logging into a donor advised fund on December 30th, trying to move appreciated stock to get the deduction in 2023, it ain't happening, right? You're going to want to act sooner rather than later to get that stock on its way out of your taxable brokerage account and into the donor advised fund. So from a year-end perspective, this is definitely one that, technically the deadline is December 31st, but as a practical matter, the different financial institutions have different deadlines for moving stock into the donor advised fund and having it count for 2023.
So I use a donor advised fund. Actually, we have two. We have one at Vanguard, we have one at Fidelity, and they are low cost. And we really enjoy them. We use them as a family trust, so to speak. They do charge an expense ratio fee, and you have the expense ratios on the stocks that you invest in. But you can let this run and give your growth. It's really incredible. It's a perpetual donation machine, and it can exist in perpetuity, and we can hand it down to our sons, and they can take over when we're no longer able to manage it. So I'm a big fan of donor advised funds. I'd like to actually give a shout out to another organization called Daffy. They are even cheaper than Fidelity and Vanguard. And they have low entry points because there are sometimes significant entry points into these donor advised funds. Vanguard has a high entry point as far as appreciated shares that you have to donate. I think it can be upwards of $25,000. Vanguard, I think the minimum might even be $5,000 to get things rolling. But Daffy does not really have that. And it's an incredible organization after I researched it. So there's many ways to do this. Lots of custodians have these things. And our family loves what it can do. We accumulate charities in the Fidelity side throughout the year with small donations, take that list, and then make bigger donations from our Vanguard fund. So I appreciate your input on this. And I would encourage people that have giving plans as part of their financial plans to really avail themselves of this. Remember also that you like to bunch your contributions, right? Because of the standard deduction. Can you tell us about that?
Yes. So in the United States, we have a high standard deduction. Okay. So the default is married couple, year 2023 would take the standard deduction. I believe it's $27,700 for the year 2023. However, if your itemized deductions add up to more than the standard deduction, you would itemize. Now that's only probably less than 10% at this point in the United States. The big three itemized deductions are state and local taxes, but limited to $10,000 per tax return, home mortgage interest, right? So you just got to look at that situation, and then charitable contributions. Well, it may not make sense. Let's say your home mortgage interest is $5,000. Your state and local, just say it's $10,000. So that's $15,000 of itemized deductions. You're still taking the standard deduction. It may or may not make sense at that point to use a donor advised fund if you're only going to give, say, $10,000, because you're still going to take the standard deduction in that example. But you still might say, look, we still like the donor advised fund features. We want to get that capital gain out if it's appreciated stock. But you might want to sort of right size the donation and sort of, like you're saying, Bill, bunch it. So what you could do is say, I'm not going to give $10,000 to the donor advised fund. I'm going to give $20,000 or $30,000 this year. And then I will take an itemized deduction this year, then make contributions to charities out of the donor advised fund going forward, and for the next year or two, just take the standard deduction. So that's what's referred to as bunching, sort of getting to critical mass. So we're itemizing. We get a big upfront tax deduction this year, fall back on the high standard deduction in the next couple of years, and meanwhile, our charities are still getting the money over time in a normal fashion.
Sean, I've got two questions. So even if you bunch, you can still make those contributions to the donor advised fund throughout the year. They don't have to be done at the end of the year, correct?
Absolutely correct, Becky. It
Okay.
tends to be that people spend their time and attention towards the end of the year, but absolutely you could do it anytime during the year as long as it's not too late.
Right. Okay. And then my second question is, in your example about putting appreciated stock in the donor advised fund, at what point does that stock turn into cash for, let's say, your church? Or does the donation go to the church in stock?
Great question, Becky. So here's the process. You work with the donor advised fund and the receiving institution. I will say, as a practical matter, it often makes sense for folks to set up a donor advised fund with the same financial institution as your taxable brokerage. That said, I myself did not do that, and it still works, right? But sometimes the practicalities will lean in that direction. What you do is you move the actual shares, 10 shares of Apple, 20 shares of XYZ, whatever it is, to the donor advised fund. The donor advised fund will immediately sell. And that's a big point, is that you don't sell, you just transfer. The donor advised fund sells. And now the donor advised fund is going to be sitting on cash. You get to determine, okay, the donor advised fund offers these 12, say, mutual funds. Here's how I want to allocate it. And usually, because we're going to be giving, we want something that's near cash, at least for part of it, so that it helps facilitate the charitable contributions. But then, so now the donor advised fund is just sitting on assets, right? It's not going to be sitting on Apple stock or XYZ stock. It's going to be sitting on some sort of mutual fund or mutual funds. You then go into the donor advised fund portal. There'll be just an internet portal, just like a taxable brokerage portal. And you advise the fund, right? Which is a fancy way of saying you just look up a charity, right? And by the way, not every charity is going to be in the portal. So you might have to look up your particular church and then they'll add it to the portal. But basically what you do is you look up the particular charity and you say, I want to make a one-time, a monthly, a quarterly gift to that particular institution. Okay. And then the donor advised fund does its work on the back end, just make sure, okay, that's a real 501c3, and it just cuts the check. So for, say, like a church, you might want to set that up weekly or monthly or quarterly, but maybe for some other charitable giving, maybe it's a one-time thing. And the receiving institution just gets a check. They don't get Apple stock or XYZ stock or even what you're holding in the particular donor advised fund. Now, one little note of caution here for the listeners. Not every charity is up to date in terms of their systems and getting these things. So sometimes you will get a letter recognizing the gift from the donor advised fund, but it'll be addressed to you in your name, and it'll say, this is tax deductible, because we're a 501c3 charity. Well, that charity may be a wonderful organization, but their systems and tax structure probably aren't 100% up to date. It is not tax deductible to you. It was tax deductible on the way into the donor advised fund. When the donor advised fund starts making distributions to different charities, that's not a tax deduction for you in the future, right? That's the whole idea, is we're accelerating that tax deduction. So get that letter, feel good that you made a little donation to charity, and then shred it because there's no tax deduction available.
Other things that you can do with this that I found is, if you want to be anonymous so you don't get the marketing mail, you can be anonymous in these donor advised funds. And I think that's a benefit if you don't want repeated marketing emails. The other thing that you can do is use an organization called GuideStar to research your charities. You can find out their Form 990 and look at their pass-through. How much are their overhead administrative costs and how much do they donate? So you can find out if it's an impact charity or not through these research tools that are on Fidelity and Vanguard, and you can use independently.
Great. Great. All right. So thanks for that, Sean. We went a little deeper probably than maybe we needed to for year-end discussions, but I like the fact that we've given folks a flavor of what a donor advised fund is if they have never experienced that before, maybe never even heard of it. So thanks for that. All right. Next, we've got taxable Roth conversions. This is something that lots of us love to do.
Yeah, and this is really for the drawdown folks in the audience, generally not speaking for the accumulators that are in the audience, right? So what this is it's saying, look, I'm retired and I've got all this money in traditional 401ks, traditional IRAs, and because I'm an early retiree, but maybe even a mid to late retiree, my income's relatively modest, right? Taxable income tends to go down once we're not working. So what this is hey, before year end, do some Roth conversions where we affirmatively move money from traditional IRAs, traditional 401ks into Roth accounts. And we're looking to pay tax on that because we're thinking, hey, we have low income, so we're going to soak up that against the standard deduction, against the 10% bracket, the 12% bracket. Now, this does not work like a Roth IRA contribution, right? A conversion must happen before December 31 to count for the year. And if you're particularly low income in 2023, you're going to want to have that happen in 2023. There tends to be at least some processing time here, but frankly, the bigger concern is you need to do some analysis to say, well, wait a minute, what was my income this year? What do I think it's going to be in December when I get my interest and dividends for the fourth quarter? You need to do some measurement here, right? And that needs to start, relatively speaking, sooner rather than later. The technical deadline for this is December 31st. But you don't, like I was saying earlier, we don't want to file a tax return in most cases where we report a negative number when we were sitting on a big IRA that we could have done some Roth conversions and soaked up some of that standard deduction and those sorts of things.
Mm-hmm. Great, great. So we just need to be aware of doing our analysis and then making sure that happens by December 31st.
That's right. And Becky, I want to mention one thing is you're going to see some commentators out there saying you got to do these Roth conversions before 2026 because in 2026, the tax rates are going up, the standard deduction's going down. And look, that is technically what's written in the Internal Revenue Code. I'm going to share my opinion, though, about the future, right? My prediction, all free predictions wrong or your money back, but my prediction is Congress is not going to let these tax hikes happen, right? You have to look at the motivation between the members of Congress and you have to look at their recent history. The motivation is to keep these tax cuts in place because nobody's going to want to be in Congress when the 12% bracket goes to 15% and that really hits seniors. Nobody's going to want to be in Congress and just let the standard deduction come back down and hit seniors, hit lower income workers. And you got to look at what they've done in recent vintage. They have been cutting taxes on traditional retirement accounts and retirees. They keep doing it, right? Secure 1.0 did it. Secure 2.0 did it. They delay RMDs. The standard deduction got increased. The 12% goes to, or the 15% goes to 12%. Congress's motivation is to not have a bunch of Americans, particularly retirees who tend to vote, have a big tax increase. So look, there's no 100% guarantee on this, but I think if you look at motivation and recent behavior by Congress, I think it's relatively a good assumption that they're going to extend those tax cuts. What that means is we don't have to be hair on fire. Hey, we got to do our Roth conversions in the next 3 years or it's going to be Armageddon. I don't see that happening. So yes, you should consider Roth conversions in the year 2023. You should do it based on your own personal circumstances and not unhealthy fear of future tax hikes.
Mm-hmm.
All right. That's awesome. The next thing we need to think about with year-end tax planning is adjusting our withholding. Why do we need to think about this and how do we do it?
Yeah. So in fact, my wife and I recently went through an exercise like this where we say, hey, how much tax do we owe in 2022? And how much do we have withheld in 2023? And if the number is much higher or much lower or is on pace to be much higher or much lower, you're probably going to want to go to your HR department and work with them on something called a W-4, where you either increase or decrease your workplace withholding. We don't like to be in spots where, hey, we're massively over withheld, so we've got a big tax refund sitting with the IRS. That's an interest-free loan. We don't like doing that. And at the same time, we don't want to be massively under withheld so that for April 15th, we've got to cut a big check to Uncle Sam. So what I would do is I would take a look at last year's tax return. There's a line that says total tax. I believe it's line 24. And take a look at your most recent pay stub. Where are you on pace? Are you on pace for 100 or 110% of that number? Probably going to be okay in most cases. But if you're on pace for 200% of that number, you might want to decrease your withholdings for the rest of 2023 and then put them at least somewhat back up for 2024. And then the same thing is on the flip. Hey, I'm not only going to get 50% of last year's liability in, I better maybe up the withholdings at year end to help mitigate or avoid any potential underpayment penalty. These things aren't huge, but it all matters. It all counts. So I think it's just looking at last year's tax return, most recent pay stub, just see, hey, am I going to be sort of in the ballpark to be right on my withholding, or at least close to right?
Yeah, we'd like to be close on our refund. I don't mind cutting a small check. I don't want to give the government a loan. And if you happen to do that and you get a good tax refund, one of the things I would recommend is look at it as a windfall. You've gotten through the year, you haven't needed the money, invest it. Don't let it get spent, right?
Yeah, and Bill, I'll just mention one other thing. I don't do this to put fear into the audience, right? But there are cases of tax identity theft where people file false tax returns using someone's record, and they're doing that to get a big tax refund that goes to them, not you. And if that were to happen to you, the IRS is going to freeze your accounts. There's remedial procedures. If you're owed a large tax refund, it's going to be a while before you get it if that were to happen. Now, there's something called an IRS IP PIN where you can go and actually get a PIN number for your tax return that you'd have to use every year. It's something worth considering, but this is also just another reason not to be expecting a massive refund from the IRS, is because if something bad happened, that refund would be tied up for months because you'd have to go through remedial procedures to establish that you are you and this tax identity theft thing happened. So just another little point there. And you could look into IRS IP pins to help protect your identity.
Good tip.
Right. All right. The next topic we want to talk about is the backdoor Roth. So tell us what we need to know about that.
Yeah, I'll give you two things on this one, Becky. Right. One, people ask, well, what's the deadline to do a 2023 backdoor Roth? Well, you're not going to find that in the Internal Revenue Code. The deadline to do a backdoor Roth is the big thing to think about is that non-deductible IRA contribution. That's the first step of the backdoor Roth, right? There's two steps: non-deductible traditional IRA contribution followed by a soon-in-time Roth conversion. That first step is due by April 15th of 2024, right? So that's like the overall and the backdoor Roth. Most people like to do it in January or February of the current year, so most people are done there. There is a second thing to think about, though, from a deadline perspective, and it is December 31st. It's this. If you've already done a backdoor Roth for the year 2023, and you still have, I have an old rollover traditional IRA, it's worth $100,000. There's this nasty little thing called the pro rata rule. If you've already done a backdoor Roth and you forgot, I have an old 401k in a traditional IRA, you could potentially do a remedial procedure, which would be to do a direct trustee to trustee transfer of that traditional IRA to your current employer 401k by year end. And that, I call that getting clean for backdoor Roth purposes. Maybe you don't like your current employer 401k, so you just decide, you know what, I'll take a little bit of a tax hit on the quote unquote backdoor Roth I did. Just something to think about. Backdoor Roth is not the only thing we think about if we're thinking about moving an IRA to a 401k. But it is something to at least consider because we generally, when we do backdoor Roths, we want our traditional IRAs, SEP IRAs, and simple IRAs to be zero at December 31st, or that backdoor Roth probably wasn't going to be a good thing to have done.
Now, who does backdoor Roths? Because not everybody has to do that, right?
That's exactly right, Bill. So generally speaking, the folks who do backdoor Roths are those who are higher income. They have earned income, so they're generally still working, and they're above the IRS published limits to make an annual Roth IRA contribution. So this backdoor tactic exists where it's a workaround. Now, it's not for everybody, right? Maybe you have a $1 million old 401k sitting in an IRA and you're perfectly happy with that. Well, fine, just don't do the backdoor Roth. There are people who have gotten to financial success, financial independence, retirement without doing backdoor Roths. The other thing too, this comes up too. What if my income was low enough to qualify to have made an annual Roth contribution, but I did the backdoor? Perfectly fine, as long as those end of year balances are zero in traditional IRAs, SEP IRAs, simple IRAs. It's just you took an additional step you didn't need to, but fine, it's no problem.
A backdoor is something that Stephen and I never did. And so I always have to kind of stop and think it through whenever I want to get that clear in my head about backdoor. They just seem confusing to me for whatever reason. So, Sean, do you have a place that we could point our listeners to, say, one of your videos or articles that would describe a backdoor Roth?
Yeah, I actually have a backdoor Roth IRA for beginners post, and I will get that to you for the show notes. Becky, so the opportunity that you and Stephen missed out on is this opportunity to have money in Roth accounts instead of taxable accounts, right? So if you guys had done the backdoor Roth, you would have had more money in Roths, less money in taxables, and just more tax-free growth. But like I said, people have gotten to financial success without deploying every last tactic, every last tool in the toolbox, right? Mm-hmm. And you and Stephen are living proof that you can be financially successful without ever having done a backdoor Roth.
I find the Roths are good because it's the last thing you're going to spend. And honestly, you probably don't want to spend it because it's a good inheritance vehicle, if I'm not mistaken. And the second point would be because it's small dollar amounts largely with low contribution limits, you want to put it in a max growth type investment. I would suggest probably all stock. There's really no reason in my mind, unless you plan on pulling that out early and need it for other things, to do anything but an all stock ETF or mutual fund. What do you think?
Well, so Bill, I tend to agree with you from a tax basketing perspective. So I'll give you an example, bonds and bond funds, right? Plenty of fun. Look, I'm not giving investment advice to members of the audience, but there are going to be plenty of listeners who say, I want some piece of my overall portfolio to be in bond funds. Well, think about bonds, bond funds. They generate ordinary interest income, right? So that's ordinary income. It's the worst type of income to hit your tax return. The other thing about bonds is they tend to be low growth, right? You don't have the Apple stock of bond funds typically, right? So we like Roth IRAs for higher growth assets. And we like to put, say, bonds in like a traditional 401k or traditional IRA where we're sheltering that ordinary income from hitting our tax return every year. And then when it comes out, sure, it's ordinary income, but we've had years of tax deferral on that. We get to control it a lot more. So tax basking is absolutely something to be thinking about all year, but year end could be part of that too. But Roth IRAs tend not to be good for low growth assets, and bonds, generally speaking, tend to be lower growth assets.
Mm-hmm. Mm-hmm. And I wanted to clarify, we do have Roth accounts. We just never deployed backdoor Roths. So we have Roths that we did our yearly max contributions to, our personal Roths.
Yeah, and the funny thing is there's actually plenty of ways to get money into a Roth account, right? There's Roth IRA annual contributions if you qualify, potentially a Roth 401k at work if you have that at work and it's the right decision for you. There's the backdoor Roth, and then there's taxable Roth conversions. So there's actually at least 4 different ways that I'm seeing that we can get money into these Roth IRAs at some point in our life. And it depends. For a lot of people, that the best time is either the backdoor Roth and or just low taxable conversions in early retirement.
Right, right. Which is what we're doing. We're 5 years into retirement, but Stephen has not taken his Social Security yet. So we are maxing out the 12% bracket every year with Roth conversions.
And that could be a great way of approaching it. Absolutely.
Mm-hmm. Mm-hmm.
And the other thing we considered too was to get our kids involved in Roth IRAs. And in your 20s, low income years, it's a good time to try and max out your Roth IRA.
All right. So here's the next topic, which I don't know anything about personally, but I know, Sean, you're going to do a great job on this, the solo 401k planning.
Yeah, so if you're a solopreneur, you're self-employed, and you're thinking about your retirement savings, the solo 401k is just a great opportunity. I wrote a book about it last year, still available on Amazon, Barnes & Noble, those sorts of places. Typically, this benefits from considerable time and attention towards year end because there sometimes can be opportunities that we lose if we don't turn our time and attention to the solo 401k before year end. Now, Congress actually recently made a law change. If you don't already have a solo 401k, you get additional time in the following year and you're filing a Schedule C, then you actually get more time in the following year. But I would say, that's great. Thank you for that tool, Congress. But I still want to be turning my attention and setting this thing up before year end. That can still be very beneficial, just to be more intentional around that. So solo 401ks have a whole host of deadlines. That's why I have a book about it. That's why I blog about them. But year end is a good time to start thinking about like a solo 401k. And this applies for our solopreneurs, right? We were at Bogleheads, Bill, and Dr. Jim Dolly pointed out that there are 27 million businesses in the United States, of which 21 million have one and only one employee. So this solo 401k matters for a whole lot of our fellow Americans, and it's just a great way to get some tax deductions and build up tax advantage wealth for our retirement.
Yeah, I'm a solo entrepreneur, basically independent contractor. We have a solo 401k, each myself and my wife. And this year, with the catch-up contributions that the late starters should not forget about, I think I'm able, given my income, to put away $74,500 between my employee and my employer contributions. So it's a significant number.
Yeah, I think it actually might be 73.5, but I'd have to double check that. You're in the ballpark, Bill.
Well, close is good enough, right?
So I don't focus too much on them unless I'm working like with an individual client. It's like, okay, we've got pen to paper now, but casually it's like, well, it's going up every year anyway. So I'm not going to commit too much of it to memory other than just knowing the neighborhood of it.
Right. All right. So we've got our next list of items that we want to talk about are things that definitely have a year-end deadline. So let's go through those. And the first one on the list is tax gain harvesting.
Yeah, tax gain harvesting, this back to the problem of appreciated stock, right? But it can be other things too, right? So we have a taxable brokerage account and we have a position that has a big built-in gain. We want to avoid that capital gains tax, right? So we could do one of two things, right? Maybe we like the position, so we just sell the position and then shortly thereafter buy it back. What that has done is it's quote unquote reset basis. So now we've got a fair market value basis in that stock or that position, that mutual fund. And because we're in the 12% or lower tax bracket, we pay a 0% long-term federal capital gains rate. So that can be good. The other flavor of this is, let's go back to somebody who has a whole lot of their wealth, say, in one tech stock, right? What they might want to do is do tax gain harvesting before year end to tax efficiently redeploy into more diversified assets. And like you said, Becky, the deadline is December 31st. If we do it after December 31st, it's going to go into the next tax year. It still might make sense to do that, but tax gain harvesting, particularly for the early retiree, can be great. It's actually a time, sometimes I like tax gain harvesting over Roth conversions if we're in a position where, boy, a lot of our wealth is in this one particular individual equity. Maybe what we do there is we prioritize the tax gain harvesting, stay in that 12% bracket, pay a 0% long-term federal capital gain rate, and get into some more diversified investments. There are other ways to deal with that. There's put options and things like that. But tax gain harvesting can be a great way to get into a better portfolio position, or if we already like our portfolio position, just to reset basis to fair market value.
Cool.
All right. So we have tax gain harvesting, which confuses me a little bit more than tax loss harvesting. Let's talk about tax loss and how do we harvest those?
Yeah, so what we're thinking about with tax loss harvesting is we have a taxable brokerage account, we have a position in there, stock, bond, mutual fund, ETF, with a built-in loss, right? It is declined in value from when we first invested in it, or it could be different times we invested in it, but it's declined in value. So what we do is we sell. And as long as we don't rebuy that within the wash sale rule window, which is 30 days before, the day of, and 30 days after, it's a 61-day window, then we get to claim that loss on our tax return. And we like doing that for two reasons. One, if we have other capital gains on our tax return, it can offset those, right? So we net out to zero. And two, if we've netted out to zero, then we can look to our ordinary income and we can reduce that by up to $3,000. So we could have W-2 income and a capital loss, and we get to reduce our W-2 income by $3,000 for income tax purposes by using a capital loss through this tax loss harvesting. So this could be a powerful way of reducing our taxes. There are some people who try to plan into it every year by having dozens of individual equities and pray that some of them will go down in value. I don't like arranging my affairs that way. I want to pray that all my positions go up in value. But all right, put that to the side. If you're sitting on a built-in loss asset, you might want to sell before year end, triple loss, and either or both offset some capital gains or get that $3,000 deduction against other income.
Mm-hmm.
So there's a couple of tricks here too, actually. And one of them is to not automatically reinvest your dividends so you don't end up in a wash sale. The other one is you can buy a similar but not identical index right away after you sell, and you don't have to wait 30 days, right?
Yeah, those are both true. The one thing I'll mention about the dividends, though, the wash sale is a to the extent of rule, right? So let's think about that for a second. So let's say on December 15th, you sell 100 shares of ABC Mutual Fund, okay, to try to trip a tax loss. And so let's say the total loss there was $3,000, okay? So now I got this capital loss, $3,000 on my tax return, 100 shares I sold, but I kept a lot of the rest of the position. So I still have a lot of it. And then on December 27th, they pay a dividend and it's reinvested into 3 shares of that same ABC mutual fund. Well, what happens is we had 100 shares that we sold at a loss. We then bought 3 back. We lose 3% of the loss through the wash sale rule there. So the dividend reinvestment, it's a to the extent rule. It's not the end of the world to have a little bit of dividend reinvestment, and we only get to claim the loss on 97 of these shares instead of 100 in my example. You got to look at your own circumstances, right? Maybe you still have a huge position and the dividend is 100 shares when it's reinvested. You have to just sort of look at your own circumstances there. But you're absolutely right, Bill, that it's very possible to buy a very similar position and get around the wash sale rule. That's a facts and circumstances determination. And 2, the dividend reinvestment can absolutely invoke the wash sale.
Yeah, what I do is I just plan on quarterly reinvesting my own dividends based on if there's a big drawdown. And that's one of the signals we need to look at for when do we look at tax loss harvesting is drawdowns. If you have a position that's run without a loss for a while, then you may not have an opportunity for tax loss harvesting. But your most recent investments in that may be an opportunity. And I use kind of, if I'm going to get a tax loss of $1,000, that's when I do it. I don't necessarily do it for small numbers.
All right. The next thing that we want to talk about is RMDs. So, Sean, we're going to talk about RMDs from your own retirement accounts and RMDs from inherited accounts. But before we start, can you give our audience just a quick definition of what an RMD is?
RMD stands for required minimum distributions, right? So you have traditional IRAs, traditional 401ks. They've been tax deferred for a long time, but the IRS, Congress has said, look, they're not going to be tax deferred forever. So during your lifetime, you're going to have to take, they call it a required minimum distribution every year. So at a minimum, you have to take a certain amount out and then thus pay the tax on that certain amount. And so for those in our audience who are in their 70s or older, guess what? Generally speaking, you're going to have to take some of that out. Now, for some people that started at 72, some people started at 73. They've been fiddling with these rules for a while now. So look at your own particular birthday and circumstances and age. But you have to take by year end some money out of those IRAs based, or 401ks, IRAs, whatever it might be, based on the balance as of December 31, 2022. And your age, the birthday you turned this year, there's an IRS table for that, and you figure it out. And then there could be these required minimum distributions from inherited retirement accounts. And this very much varies based on when you inherited the account. Was it before or after the year January 1, 2020? This is a bit of a mess out there. But even so look at the rules, maybe talk to your advisors around this. One thing about the inherited retirement accounts is, even if you have a small RMD or no RMD, you still might want to take it out of there, because a lot of folks, if you inherited in the year 2020 or later, you're subject to a 10-year rule. A lot of folks, not everybody, but a lot of folks are subject to, hey, it's got to be emptied by the end of the 10th year after death. Well, you probably don't want to just wait for 10 years and then empty it in year 10, because now you have a tax time bomb, right? So you're probably going to want to be intentional about emptying that inherited retirement account over the 10-year period based on your own income in each year, so that you don't have a tax time bomb in year 10. And that's regardless of whatever the RMD rules. And the IRS, I don't want to bore the audience with this. A lot's been written about it. The IRS and Treasury have issued odd proposed regulations, some notices. That situation's a mess. But regardless of that RMD and the 10-year rule situation, you might want to be just taken out anyway, just so that you avoid the year 10 tax time bomb.
Mm-hmm. Mm-hmm. So in other words, RMDs have to be taken by December 31st.
That's exactly right, Becky.
And what happens if we forget and we don't do it?
All right. So if we forget, that's probably an indication that we probably need an advisor in our life, right? That's one. But two, if we don't remedy that situation, we're going to be in a penalty situation. We're going to have to pay a penalty on the untaken RMD. So that's a situation where we could, now that penalty can be waived, by the way, but we're going to have to probably take that, we're going to have to take that RMD. That we got to take. And we then have to think about remedial action, or we're going to have to pay a penalty for not having taken during the calendar year.
Okay. How bad is the penalty?
And they just changed this, right? It used to be, well, I'm trying to think. It can be up to 50%, but I think they lowered it to 10. There's like 3 different penalties. It might be 10%, it might be 25%. It used to be a 50% penalty. I think it still can be. So you want to spend some time and attention on that. And it's not that hard to take an RMD. And actually, to be fair to the financial institutions, sometimes folks say, oh, this financial institution doesn't have great customer service, or whatever it is. The financial institutions are pretty used to RMDs now. So their portals, in many cases, not all cases, but there's some large brand name financial institutions that actually have really good portals around taking your RMD.
And is it normal for the institution to tell you what it needs to be? Or I know that there's a table from the IRS where you can calculate it yourself, but normally we don't have to calculate it, correct?
That's exactly right. So you should be getting a notification every year. Hey, you know what? Well, first of all, your financial institution needs to know your birthday, right? So they know your birthday and they know your year-end balance. And oh, by the way, the IRS knows your year-end balance on all these accounts. And so you should get a notice. And in fact, you should be able to log on. Some of these financial institutions are good enough where you can log into an RMD center and it will tell you just in that center, right? It should have been mailed to you before. There should be a portal with that number. But they'll literally say, hey, you have an RMD this year of whatever the amount is. Do you want to take that? And you can also change it, right? So you could take more than your RMD, right? It's a minimum distribution, but you could take more. The other thing is you could say, hey, I have 3 different IRAs. I want to take the RMD for all 3 from one particular IRA. That's allowed. Now, 401ks are different. If you have a 401k, you have to take from that specific 401k, not from another 401k, not from an IRA. So these rules get a little complicated. But it's absolutely November, December. I would say November, you should be thinking about, hey, if I haven't taken my RMD, I absolutely should be taking my RMD. The other thing to think about is if you inherited an IRA this year, so maybe your parent, your loved one died in January or February, and they had an RMD, and they didn't take it because they died early in the year, and they weren't, New Year's Day, I'm taking my RMD. They probably wouldn't have known it on New Year's Day. You probably have to take that RMD for them because they owed it and then they died, sadly, before they could take it. So that's another thing to be thinking about. Did I inherit an IRA this year? If I did, I may need to be taking an RMD. Now, look, if the person was 65 when they died, they didn't have an RMD for the year. So you're not going to need to take an RMD for them. But if they were 75, 80, yeah, they had an RMD this year. Maybe they took it, established that they took it. Okay, I don't have to take it. But if they didn't take it, you're going to have to take it.
Right. Stephen and I have come across something that I didn't know before a year or so ago. We have a small inherited traditional IRA, and we've discovered that we can use our RMD for our tax instead of making quarterly tax payments. So like in our situation, we don't have income, but we are doing Roth conversions. So that shows up as income on our taxes, right?
Yes.
And we should be doing quarterly tax payments because those taxes aren't going to come from an employer. But we discovered that we can take an RMD out of our inherited IRA at the end of the year, tell Vanguard that we want it sent in to as taxes. Don't send us the money, send the IRS the money, which they will let you do 99% of it, not 100%. And that amount of money is going to the IRS, and the IRS will look at it as if it had been going to them all year.
Becky, you bring up a great point and a great issue. So a few things on that. One, Roth conversions. I have a YouTube video up on this, so I can share it on the show notes. When you do Roth conversions, a lot of times they ask you, do you want to withhold federal and or state income taxes? You're in Texas, so they're not going to ask about state taxes. Generally speaking, there's no reason, if you're doing a Roth conversion, you want no money withheld from that, right? So Roth conversion itself, do not withhold, generally speaking, federal or state. Okay. But what about a inherited IRA or even an IRA that you're just living off of? And I like the tactic around the inherited IRA. You can take a distribution and they'll ask, hey, do you want money withheld? And you're now getting, when you take money out of an inherited IRA or just a traditional IRA to live off of, you're getting back to where you were when you were at work with W-2 withholding, right? W-2 withholding, retirement account withholding is deemed to occur equally throughout the year, which is a fancy way of saying it's sort of better, frankly, than estimated tax payments, because estimated tax payments happen for the quarter they're made. So if you make estimated tax payments only in the fourth quarter, you could potentially be subject to a penalty because it wasn't made for the first quarter, second quarter, third quarter. But if you, on December 1st, take $10,000 out of your traditional IRA and say, hey, Vanguard, why don't you take $9,900 and send it to Uncle Sam as withholding? That's deemed throughout the year, so you're getting coverage for quarter one through quarter four. It's a nifty little way of managing our tax liability when we're retired. It also means you don't have to go on to directpay.irs.gov 4 times a year and make the payment. It's one less or 3 less things to do in your life. So that's nice.
That's right. That's right. It makes it simpler. So I love it.
All right. We've got things that need to be done by December 31st. Now we're moving towards things that can actually wait till next year. What are those kinds of things, and how do we manage those?
Yeah, so the big ones are traditional IRA contributions, Roth IRA contributions, and HSA contributions. Those can happen by April 15th of 2024. If we do that, right, it's perfectly fine to do that. We need to be sure that we designate the contribution as being for 2023. Anytime we make one of those contributions, it defaults to the year that we made it for, or that we made it, right? So if I make a 2023 IRA contribution in February of 24, the software is going to say that's a 2024 contribution unless I very specifically make sure that it's designated as being for 2023. So that's one thing to think about. 2 is, look, if we know our numbers in 2023, we generally want to make those contributions in 2023 just to get the maximum tax deferral, tax-free growth. But maybe we don't have the cash, or maybe we don't know our numbers. It's perfectly okay to say, I'm not sure where my income's going to fall out this year, or I don't have the cash today, but I'll have it in January or February. So make those contributions in 2024. That's okay too. And then the third thing I'll just mention is with the HSA. If we're a W-2 job and we're doing our HSA through our workplace, I really like doing payroll withholding for our HSA and not cutting a check to the HSA. The reason I like that is because we could save on payroll taxes in addition to income taxes when we put our HSA money in through payroll withholding. We don't get that payroll tax benefit if we simply cut a check to the HSA, regardless of the timing of that check.
Yeah, with regards to our Backdoor Roth and HSA, we escrow or sinking fund the money throughout the year. And then, as you mentioned, I think before, in the first week of January is when we cut the checks for that year to our HSA and Backdoor Roth. I'm not a W-2 employee, so I don't have the payroll tax withholding. But I like to do that because you get another, 14 months of growth that if you wait till just before tax time and the next year, you've missed out on.
Yeah, that's right. If there's no reason to wait to April 15th, but it is good to know that you have that option on the table that you could, in theory, wait. If you didn't have the cash, or your income's borderline, you're not sure if you qualify for an annual Roth IRA contribution, or maybe you need to do the backdoor instead. So it's nice that we have some flexibility, but in many cases, there's no particular need to take advantage of that flexibility. But in some cases, there is.
And if you open your HSA in the latter part of the year, you can, before April 14th or 15th, max that out, right?
Yeah, there's a last month rule in the first year you have HSA coverage. If you have it by December 1st of the year, you can actually make a full year's contribution. Generally speaking, let's say you had an HSA, but now you changed jobs in July. So you had a high deductible plan with an HSA from January to June. And then July 1, you go across the street to a different employer, you change your medical insurance, and now you don't have a high deductible health plan. You can only do 6 months of contributions. They take the published limit, they multiply, in that case, 6 divided by 12. And so your limit's only half the published limit. But when you're first adopting a HSA, if you adopt it by December 1st, for that 1 year, you get to make 12 months worth of contributions, so the published limit.
Okay. Now, Sean, remind me, the HSA contributions, though, have to happen in the calendar year. Is that correct?
Well, they often should, but no, maybe you're like Bill. So you can't even do payroll withholding into your HSA. And you're like, oh, but we meet the 12 months for the year 2023 based on having high deductible health plan as our only medical insurance, right? That's a big requirement for any HSA contribution, is for that year, your only medical insurance was a high deductible health plan. So let's say you're like Bill and you're self-employed, you have a high deductible health plan, or maybe you're a retiree with a high deductible health plan. You don't have to be like Bill. It's always great to be like Bill, but you don't have to be like Bill. Right? You just be a retiree with a high deductible. Maybe you're before Medicare, you have a high deductible health plan. You have till April 15th to cut that check into the HSA for that year. Again, you have to designate it as being for 2023, even though it's coming in April, so that it's a little bit of flexibility. But Bill has a very valid point around, hey, you know what? If we can get more tax-free growth by doing it earlier in the year, that's a valid point too.
Well, as we mentioned too, HSA is the health savings account, and it's a significant advantage from tax planning because it's triple tax-free. It goes in untaxed, it grows untaxed, and it comes out untaxed. There's lots of rules around it. We should probably do an episode on it, just to sort of go through the details of it, because it's one of the first accounts you want to contribute to in your cash use waterfall.
Right. And then there's something about the backdoor Roth that we can talk about real quick. You said something about a split year backdoor Roth.
Yeah, and I mentioned this earlier, right? So technically there's no deadline for a backdoor Roth other than for the backdoor Roth IRA. The thing that has to happen for 2023 is that non-deductible traditional IRA contribution has to happen by April 15th of 2024. If you make that non-deductible contribution in 2024, or you do the Roth conversion step of the backdoor Roth in 2024, that's what I refer to as a split year backdoor Roth IRA. So it's for 1 year, but it occurs either in the later year or the steps are split. It can create a weird tax return filing situation that a lot of folks don't get right. And so that's why I have a whole blog post on what I refer to as the split year backdoor Roth. I don't like to toot my own horn too much, but we all do to an extent. And I'm not aware that anybody else has ever written that up, that, oh yeah, this 8606, it gets a little weird when we do the split year backdoor Roth. So I think I'm like the authority because I'm not aware that anybody else ever took the time to write that up. So it's good to be a small fish in a small pond.
All right. So now we've got our last topic is 2024 tax planning at the end of 2023.
One thing is, depends on when you're listening to this episode, what your workplace situation looks like. Oftentimes, this time of the year is open enrollment. And so we might want to be thinking about, hey, it's open enrollment benefit season. Maybe 2024 is the year I adopt the high deductible health plan and start contributing to an HSA, right? It might be this is a limited window of opportunity where I could, Bill's right, that the HSA has a lot of good tax advantages. So just something to think about. The high deductible health plan, by the way, may not be right for your particular situation. And if it's not, Becky and Steven got to financial success, retirement without doing a backdoor Roth. Well, there are plenty of Americans who will get to those positions without doing it in HSA. But that said, the HSA is a really nifty benefit. So that's one thing to think about. Second thing I'd think about is, am I self-employed? Am I a solopreneur? Am I one of those 21 million Americans who works for themselves? this might be the time, hey, you know what? I want to really get serious about my tax planning. I want to think about what solo 401k, maybe just for 2024 and forward, right? I want to be real intentional about it. I don't want to scramble for 2023. No, I'll just do it for 2024 going forward, be real intentional, start doing that analysis in 2023. For some solopreneurs, there's something called an S corporation. And I will say, I think it's oversold in the personal finance space, but for some folks, it absolutely can make sense. And now might be a good time to get that set up for 2024. So there's just a few things we might want to focus on at the end of 2023 to go into 2024 so that we're cooking with gas for the year 2024 when it comes to our tax planning.
So there is one unique situation too that I want to at least touch on. You're a W-2 employee, but you have a side hustle and you open a solo 401k. Can you talk about that a little bit? Because that poses some distinct advantages as well.
It absolutely can. And by the way, so I tend not to be a fan of the SEP IRA. So that's like the competitor to the solo 401k. That's the Springfield to Shelbyville of solopreneur retirement accounts. Yes, if we have a side hustle, we should be thinking about opening up a solo 401k, maybe a SEP IRA. Depends on our situation or our profile. The solo 401k and the SEP IRA for the side hustler can offer an employer contribution. So maybe my side hustle generates something like $20,000 of taxable income. Maybe I could put between $4,000 and $5,000 as an employer contribution to either a SEP IRA or a solo 401k. So that's one thing we could think about if we're a side hustler. But two, if we're a side hustler, maybe we don't like our workplace, our W-2 401k. Well, that might be an argument to do a solo 401k instead of a SEP IRA. So maybe we don't like the investments in there. Maybe they don't offer a Roth and we want a Roth. I mean, there are different reasons we may not like our workplace 401k. So maybe what we do is we say, okay, I'm going to contribute at work to the solo 401k only to the extent to get the employer match, right? And so maybe that's $5,000. Well, the way the rules work for that employer contribution, I'm limited to $22,500 for 2023. And those numbers change every year. I could do with that side hustle, $20,000 of income, I could do a $17,500 employee contribution. Now I can't do the employer contribution if I do that, but I could essentially max out 401ks, $5,000 at work, $17,500 as an employee of my side hustle. And now I'm cooking with gas and I got better investments going now. And that's a reason to do the solo 401k, not the SEP IRA, because the SEP IRA only allows the employer contribution. It'd be like $4,000 or $5,000. It does not allow an employee contribution, which in my example, if I'm doing $5,000 at work and I have $20,000 of side hustle income, I could do $17,500. So absolutely something to be thinking about if you're a side hustler.
We've covered a lot of topics. People are going to have to probably listen to this episode 10 times and find the pieces of it that apply to them. But end of year tax planning is important, which is why we've done this today. We're going to publish this one in time for everybody to do their end of year tax planning. Sean, you've been incredibly helpful as always. It was great meeting you and seeing you at Bogleheads. Look forward to seeing you again, hopefully at Economy or FinCon next year. You've posted this article covering all these topics, which we'll post in the show notes. Are there any other resources you would point folks to other than maybe your book for solo 401ks that may help them with their end of year tax planning?
It really depends on their particular circumstances, right? There are absolutely resources out there on donor advised funds, on backdoor Roths, on HSAs, right? So I'd say, look, my blog is a resource on many of these topics, FITaxGuy.com, but there's certainly other commentators out there that have made some really good contributions as well. Nothing in terms of year end, there's no one particular source that just jumps out at me, but there are plenty of good resources. And I hope what we've done today is, raised awareness and gotten people thinking about their particular circumstances, right? Maybe you don't have a high deductible health plan. You say, well, okay, that's HSA, not for me, right? Thanks, but no thanks, but that's fine, right? Look at other aspects of this episode and just think about your own circumstances. And it's about getting a little bit better in our tax planning as we go forward. And these things stack on top of each other.
Well, hopefully we provided our listeners with a checklist, and some items there apply, some don't. and maybe we can present it as a checklist in our show notes. Do I need to look at this? Should I think about this? Should I act on this? And it's important to reflect on these things so you can act in tax plan, because that's one of our biggest bills, and reducing that bill is important for late starters too. Right. So at any rate, do you have any particular recommendations for our late starter audience with regards to tax planning, or does our checklist really apply to everybody?
I think in many ways the checklist applies to everybody. The one thing I will say, though, is I think for the late starter, maxing out or coming as close to as we can those traditional deductible retirement accounts, right? I'm seeing this out there in the personal finance space. You got to do Roth, you got to do Roth, you got to do Roth. I disagree with that for many reasons, but particularly for the late starter. The late starter needs to build up the numbers on their balance sheet. And the easiest, quickest way to do that is through traditional deductible retirement account contributions, particularly at work. And you should feel good. If you're a late starter and you're like, look, I'm now going to commit to maxing out my traditional deductible 401k, you should feel really good about that. And you should not let any personal finance commentator, myself included, say, oh, that's a bad thing to be doing. No, that's a really good thing to be doing if you're a late starter, but also for a lot of Americans who are not late starters, but particularly for the late starter.
I agree, Sean. So I just wanted to say again that all of this information we talked about today is on your website, FITaxGuy.com, and the article is called 2023 Year-End Tax Planning. So I hope folks go check that out. And Sean, where can folks connect with you if they want to know more?
Yeah, so you can find me Twitter, Sean Money and Tax. You can find me at FITaxGuy.com, and you can find me on my YouTube channel, Sean Mullaney Videos.
Awesome.
Okay, Sean. We want to tell our audience, too, that they need to avail themselves of our resources on our website. We want to hear from you. Please leave us a voicemail or a speak pipe so we can put your questions on the show. If you find value in the content we provided, we encourage you to just show a little bit of support by going to Buy Me a Coffee or the Support Us link on the website and buy us a little coffee to help defray some of the costs of this show. Sean, it's been a pleasure as always. You are our tax correspondent. I'm sure we'll have you back again in the future. Thanks again for your time on Catching Up to Fi.
Bill and Becky, it's always a pleasure. I'm honored to be a guest on Catching Up to Fi.
Thanks.
All right, we'll see you next time. We hope you've enjoyed this episode of Catching Up to Fi. We would appreciate it if you could leave a 5-star review so that our message can reach others.
We are not lawyers, financial advisors, accountants, or tax experts. Please consult your own professional advisors before making any important decisions. Our content is for entertainment and education purposes only.
We'll see you next time on Catching Up to Fi.